Okay, let me now welcome on board Debadatta Chand, the MD and CEO at BOB, to talk about how their numbers have been. Of course, lots of talking points really that one would want to flag off. The slip in NIMS, which has happened to 2.96%, and the cost of deposits, which have risen to 4.91%. Mr. Debadatta, how do you see margins trending amid rising costs of funds, and how is it that you're going to manage the margin pressures going forward?
See, on both the numbers, the margin has improved to 2.96 over 2.91 last quarter. So on a sequential basis, the margin has improved. At the same time, the cost of deposit has come down from 5.05 to 4.9. So that has also improved. So this is something that we are talking about in terms of the prudent liability management, wherein we focus on the low-cost deposit, and the outcome is positive in terms of a better, what you can say, the net interest margin. And if you look at the data also, there is a positive increase in the net interest income, which is a significant, what you can say, in case we look at the what is happening in the system. So in that way, I believe, both in terms of margin front, managing the cost part of it, the bank has done well.
Right, okay. And Mr. Debadatta, your cost to income ratio has surged 51%. What measures are planned to bring it down?
So that's a very important thing. Actually, we intend to operate at a lower cost to income ratio. So if you look at the last quarter, it was below 50. And this quarter, because of we are also expanding branches, so the operating expenses has gone up marginally higher. So in this scenario, this quarter cost to income has gone beyond 50, but on a half year basis, it is below 50. So obviously, the efforts would be to bring it below 50 going forward. And the bank is taking multiple steps therein in terms of how do you optimize on the operating expenses, and more particularly because the employee cost has been very less here. It is because of the other operating expenses, the cost to income has gone up. We'll be taking control of that. And I think we'll be operating below 50 level going forward.
Right. So what about your standard asset provisioning? Because that's risen to about almost 506 crores. Was it because of any sector-specific stress?
No, actually, as I said, we are making bit of the prudent provisioning norms considering the ECL framework in mind. We made a floating provision of almost 400 crore this quarter, taking the floating provision to almost 1,000 crore. And when the ECL framework is already announced, going to be implemented sometime later, I think we need to be prudent in terms of managing our provision, both in terms of floating and also the standard asset provisioning. So as in today, it is not because of any we have some account specific provision that we have made just to buffer for a migration to ECL.
Right, okay. And recovery from written off accounts have dropped sharply. How do you plan to improve recoveries going ahead?
No, that's what actually, if you compare the Q2 of last year, there was a one-up in Q2 of last year because we had a substantial recovery of out of the TWO account, and that boosted the operating profit and also the net profit. But this year, there is no one-off. This is a normalized quarter in terms of the non-interest income. So there is no one-off income out of the recovery, or there is no one-up in terms of incremental treasury income. So in that way, I think it's a normalized quarter, but our normal run rate per quarter on the TWO recovery is something around 700 to 750 crore. And I think if you look at the average of last many quarters, it comes to that range, excluding the one-off. So in that scenario, I think the Q3 and Q4 will be getting back to the normalized 7 to 750 crore per quarter. And that typically put us into a comfortable range in terms of our kitty is quite large. Almost 60,000 crore is the kitty of TWO. So in that scenario, I think we have a good opportunity to recover money. And then we'll going back to slightly a higher recovery as compared to the recovery we have made in this quarter.
Right. Your corporate credit growth, though, has picked up. Are you seeing renewed demand from infrastructure and manufacturing as a segment?
So our overall growth is almost 12% on the credit side, and that is mainly propelled by the growth in RAM. The retail, agri, and MSME almost at 16%. Our retail continue to grow at a much faster pace of 17.5%. So that is one of the, what you can say, as a business objective we are pursuing to retailize more. At the same time, the corporate growth sequential is 8%. And typically we see the Q3 and Q4 is very productive for corporate loan growth. And my expectation is that for a full year, we'll be somewhere in the range of 10 to 11%. Looking into sector-specific demand, I think the demand is across because since we have been into a busy season quarter, so we are finding demand across in terms of enhanced working capital requirement. Some of the sectors like renewable, data centers, commercial real estate, there are demand over there. In terms of the infra, road is always there. A couple of core sector also, we have a couple of proposals therein. We have a strong pipeline of almost 65,000 crore. Out of that, 40,000 crore is already sanctioned, not disbursed. So in that scenario, I think there is a good pipeline, strong demand, and expecting a corporate loan growth of almost 10 to 11% for the full year.
Okay, and also help us understand if you have any capital raising plans, given your credit growth and CET1 are at 13.36% this time.
See, our CRAR without adding the profit is at 16.5 level, and adding profit would be something 17.34. So in terms of a growth capital, future capital, buffer capital, we are adequately capitalized as of today. At the same time, earlier we announced to the market that we have an enabling provision to raise 8,500 crore of capital in a medium-term outlook till 2028. So the only impact on CRAR I can think is the ECL framework that can put slightly a CRAR lower. So we're evaluating all this, but as of today, there is no plan. But in case there is a scenario where we see that there is a significant impact because of the ECL or otherwise, then possibly we may think of, but that will communicate at a proper time. As of today, I think the enabling provision, it stands, and which we have already announced to the market, and there is no immediate plan for that.
Right, Mr. Chand, great to have you today on the show. Thank you so much.